Dividend income is one of the most popular ways to earn passive income from the stock market. And in this video, we are going to explain everything about dividends in simple words. If you are a beginner and want to build wealth slowly while also earning regular income, then dividend investing could be the perfect strategy for you. So make sure you watch this video till the end, and don't forget to subscribe to our channel for more finance and investing content. First, let's understand what dividend income actually means. When you buy shares of a company, you become a part owner of that company. If the company makes profits, it can either reinvest those profits back into the business or share a portion of them with shareholders. This shared profit is called a dividend. So dividend income is the money you receive from companies just for owning their stocks. You don't need to sell your shares to earn this money. As long as you hold the stock, you can keep receiving dividends. Now you might be wondering, why do companies pay dividends? Companies that are mature and financially stable often generate more cash than they need for daily operations and expansion. Instead of keeping all that cash, they reward shareholders by paying dividends. This also shows that the company is confident about its future earnings. Many famous blue-chip companies around the world have a long history of paying and even increasing dividends every year. Dividends are usually paid on a regular schedule. Most companies pay dividends quarterly, which means every 3 months. Some companies pay monthly, while others may pay semi-annually or annually. When a company declares a dividend, it announces how much it will pay per share and on what date. If you own the stock before the ex-dividend date, you are eligible to receive that dividend payment. Let's look at a simple example to understand this better. Suppose you own 100 shares of a company that pays a dividend of $1 per share every year. This means you will receive $100 in dividend income annually. If the company pays quarterly, you would receive $25 every 3 months. This money comes to you as cash in your brokerage account, and you can either withdraw it or reinvest it. One important concept in dividend investing is dividend yield. Dividend yield tells you how much income you are earning compared to the price of the stock. It is calculated by dividing the annual dividend per share by the stock price and then multiplying by 100. For example, if a stock pays $2 per year in dividends and its price is $40, the dividend yield is 5%. This means you are earning 5% annually as income, not counting any price appreciation of the stock. Many beginners think that a higher dividend yield is always better, but that's not always true. Sometimes a very high yield can be a warning sign that the company is in trouble and its stock price has fallen. The company may even cut its dividend in the future. So instead of chasing high yield, it is better to focus on strong companies with stable earnings and a history of consistent dividend payments. Dividend income can come from different types of investments. The most common source is dividend-paying stocks, but you can also earn dividends from ETFs and mutual funds that invest in dividend stocks. Another popular option is REITs, or real estate investment trusts. These companies own income-generating real estate and are required to pay most of their profits as dividends, which is why they often have higher yields. One powerful strategy in dividend investing is reinvesting your dividends. Instead of taking the cash, you can use your dividends to buy more shares of the same stock. This is called a dividend reinvestment plan, or DRIP. Over time, this creates a compounding effect, where your investment grows faster because you are earning dividends on a larger number of shares. Compounding is one of the biggest secrets to building long-term wealth. So why do so many investors love dividend income? One reason is that it provides a steady stream of passive income. Whether the market is going up or down, you can still receive dividends as long as the company continues to pay them. This makes dividend investing especially attractive for retirees or anyone looking for regular cash flow. Another reason is that dividend-paying companies are often more stable and less volatile than high-growth stocks. Dividend income can also help during market downturns. When stock prices fall, dividend payments can provide some comfort and reduce the emotional stress of seeing your portfolio decline. In fact, many long-term investors use dividends to buy more shares at lower prices during market crashes, which can boost future returns when the market recovers. However, it's important to understand that dividends are not guaranteed. Companies can reduce or completely stop paying dividends if their profits decline or if they face financial difficulties. That's why diversification is very important. Instead of relying on just 1 or 2 dividend stocks, it's better to build a portfolio of different companies across multiple sectors. Another thing to keep in mind is inflation. If your dividend income does not grow over time, inflation can reduce your purchasing power. That's why many investors look for companies that not only pay dividends but also increase them regularly. These are often called dividend growth stocks, and they can help protect your income against inflation in the long run. Let's talk about taxes briefly. In many countries, dividend income is taxable, although the tax rate can vary depending on local laws and the type of dividend. Some dividends may be taxed as regular income while others may have lower tax rates. It's always a good idea to understand the tax rules in your country or consult a tax professional so you know how much of your dividend income you actually get to keep. Now the big question is, how can a beginner start with dividend investing? The first step is to open a brokerage account that allows you to buy stocks or ETFs. Next, start learning about strong companies with good financials and a history of paying dividends. If you don't want to pick individual stocks, you can start with a dividend ETF that gives you instant diversification. It's also important to set a goal. Ask yourself how much dividend income you want to earn in the future. For example, if your goal is to earn $1,000 per year in dividends and your average dividend yield is 4%, you would need to invest around $25,000. Having a clear goal can motivate you to invest regularly and stay disciplined. Consistency is key in dividend investing. You don't need a large amount of money to start. Even small monthly investments can grow into a big portfolio over time. The earlier you start, the more time compounding has to work in your favor. Remember, building dividend income is like planting a tree. It takes time, but once it grows, it can provide fruit for many years. Another smart approach is to increase your investments whenever your income increases. If you get a raise or bonus, consider putting a portion of it into your dividend portfolio. Over time, this can significantly boost your future income and help you reach financial independence faster. Many successful investors use dividend income as part of their long-term strategy. Some use it to cover living expenses in retirement, while others reinvest all dividends to maximize growth. There is no one-size-fits-all approach. The best strategy depends on your age, financial goals, and risk tolerance. It's also important to stay patient and avoid emotional decisions. The stock market will go through ups and downs, but dividend investing works best when you stay focused on the long term. Instead of worrying about daily price movements, focus on the quality of your companies and the growth of your dividend income over time. Before we wrap up, let's quickly summarize. Dividend income is money you earn from companies for owning their shares. It provides passive income, can be reinvested for compounding, and is popular among long-term investors. While dividends are not guaranteed and come with risks, a well-diversified portfolio of strong companies can provide steady income and help you build wealth over time. If you are serious about improving your financial future, dividend investing is definitely worth learning and considering. Start small, stay consistent, keep learning, and let time do the heavy lifting for you. That's it for today's video. If you found this explanation helpful, make sure to like this video and share it with anyone who wants to learn about passive income. If you have any questions about dividend investing, drop them in the comments below. And most importantly, subscribe to our channel for more simple and practical finance tips that can help you take control of your money and build long-term wealth. Thanks for watching, and I'll see you in the next video.